Hello, everyone. We'll get started again with our programming. So I see that we've had a fan club here for our PO, for our previous speaker. This is great. Please go find a seat, or maybe chat further outside. We have the next panel coming up, which is the evolution of on-chain credit markets. And we'll have our moderator, Ben Rodriguez, who is a protocol specialist at Coinbase. We'll have Marcin from RedStone, Rahul, who is at Gauntlet, and we have Merlin, who is the co-founder of Morpho. So please give a big round of applause for our panelists.
No smoke. Where's the smoke? All right. Hello, everybody. My name is Ben Rodriguez. I'm a protocol specialist at Coinbase. We're going to be talking about on-chain credit markets today. All right. So I'm going to let my panelists here, each introduce themselves, and we're going to get started into the programming. We'll get into what we're going to be talking about. So Merlin, why don't we get started with you? Introduction, what you do?
Sure. 1, 2, 3. Can you hear me?
Yeah.
Yeah.
Can you hear Merlin?
Yeah. Okay.
Cool.
Let's go. So I'm Merlin, co-founder of Morpho. Morpho is the universal lending network. So we allow anyone to build earn borrow product on top of Morpho. There's close to 13 billions of total deposits, and yeah, that's it.
Hey guys, I'm Rahul, the head of institutional partnerships at Gauntlet, one of the largest curators out there, over $2 billion of TVL.
Hi everyone, Marcin over here, co-founder of RedStone. We are the fastest growing blockchain oracle on the market, protecting billions of dollars on-chain, supporting Gauntlet, Morpho, and plenty of other DeFi protocols, available on over 100 chains. And recently we also acquired Credora, providing the largest DeFi ratings platform, which is going to be pretty relevant for the panel. Excited to be over here, thanks.
Awesome. So for the topics that we're going to go over today, we're going to set the stage a little bit, bridging a little bit with TradFi and to on-chain credit markets. We're going to talk about risk and trust as well, yield, because everybody loves yield, and what we're looking for into the future, okay? So let's set the stage. We're recognizing here that we're in Buenos Aires, right? And so this is the perfect place to talk about on-chain credit, right? This is the city that lives the reality of why alternative finance rails matter, right? So, and Devconnect brings us all together here. So let's start with a simple analogy, right? For the traditional bank, for everybody here, right? It's a black box, right? So I give the money, and inside that black box, there's a few things that happen, right? You have the software that updates the ledger. You have a risk team that decides who gets the loans and what the terms are, and some auditor that verifies the assets that exist. And for that reason, they get to keep 95%, and they give me a paltry 0.5%, right? So on-chain credit is the unbundling all of this to be very transparent and competitive layers on-chain. So there's a two-part question to everybody here, all right? If you had to explain on-chain credit to local business owners like in Palermo versus a hedge fund manager in New York, how would your pitch change? And for each one of what you're building, which department, so to speak, of what I told you about this black box, are you trying to unbundle?
Right. So the first one we need to explain is a merchant or
yeah, to a merchant
okay.
or a hedge fund manager.
So for the first one, I think I would be and say that on-chain credit is basically the capacity to earn and borrow any money. So especially peso or dollars, just with a internet connection, without relying on any bank. You can just connect with your smartphone or your desktop and get a credit line of credit or earn yield on your deposit, and that's it.
Amazing. Anybody got to add on to that, and then we'll get into the second part of the question.
Yeah, I think one thing that I would add, and I think Merlin got it exactly right, is that, it's no secret that a lot of people in Latin America want to hold US dollars because of the inflation in their original countries. But one thing that's not as well known is that these folks find it very hard to get yield on it, right? So if you hold US dollars in America, you can pretty easily buy a bond fund or a high yield ETF that will generate yield. But in Latin America and other countries, you don't have that. And so we think, on-chain lending, vaults, that kind of Gauntlet, Morpho, and RedStone kind of collectively build and work on are a really good use case for that. And maybe one thing on the kind of the hedge fund point is that you really want to meet them where they're at, right? So you want to draw analogies to products that they're very familiar with, and say, hey, this product, this on-chain yield vault is very similar to this other product, and kind of draw the pros and cons there. Happy to go into details there, but that's high level how I'd think about it.
Yeah, I would just focus on what they care about. And to a person in Palermo, I didn't even go into like the specifics of the on-chain environment, how it works. I would just tell him, you can borrow money more cheaply. Like you, instead of paying, for example, 10%, you're paying 8%, just because the whole process is more streamlined and operationally easier. And if that person is going to hear, hey, I'm going to get something cheaper, it's going to be already a value. Then there is a question about the UX, right? Like how exactly it's going to be achieved. Like, does that person have to set up a wallet, or does it have to go to a specific app? This is where, for example, in my opinion, Morpho is going to help abstract away many of those steps with partners such as Coinbase, such as other exchanges, fintechs, and so on and so forth. To the hedge fund manager, I would say, man, you're finally cutting out all those intermediaries. Some of them you probably perceive parasitic because they don't bring much to the value chain, and you can finally just streamline this operation. I recently heard the statistics. I still haven't, I've heard it on this conference, but I can believe it, that whenever there's a credit with a 10% borrow rate, for example, about 2% out of this 10% is just going for operational cost for that borrow and lend to happen. So on chain, I believe it's going to be just way more effective.
Awesome.
I just want to add a real use case with Morpho. It's Lemon, which is a fintech with 5 million of users in Argentina, and they have like an earn product that allows all their users to earn and deposit USDC and USDT. So most of the deposits are in USDT for sure, but that allows users to actually get yield from like 5 to 6%, something that they can't do anything else anywhere else.
Amazing. We love real use cases here. So to the second part of the question, right? I'll start with you, Marcin, right? I mentioned that, like, in the traditional banks, right, there's like, a couple of like different departments, right, that determine all this for credit, right? So what is RedStone unbundling from the traditional banking department?
Yeah, so RedStone is unbundling the pricing engine. So we ensure that the assets that are taken into consideration in the whole operation, may it be tokenized or crypto native assets, is priced accurately how the market is defining that. Over there, you have 3 major types of price feeds. The first one is the market price feed, so how the market is currently trading something. But for many of the tokenized assets, that market price is either usually skewed or sometimes even non-existent because those assets are not traded. So then you look into proof of reserves. So you look into how much of assets is held in Web2 custody, and then you deliver it on chain. So for example, if there is a default in Web2 position, then you're going to reflect that there is a haircut on the actual value on the fund or whatsoever. And the third type is fundamental value from on-chain contract. So for example, with liquid staking tokens, you can look into the contract of Lido, and you look how much ST-ETH you're going to get for every wrap-staked ETH that you're going to redeem within a specific period. And then on the other side, we recently acquired Credora, that in that department is going to do the risk rating assessment. So as people were talking over here about the yield, for example, 5-7%, this is, I would say, on the scale, the healthy long-term rather yield, but some people try to chase 20% yield over the year. Those products many times are associated with higher risk concentration. And with Credora, what we try to assess is the construction of the product, how much transparency there is and where it's allocated, and what is the probability of default or significant loss. If it's higher, then naturally it should get a lower rating. And the rate is usually between D to A.
Awesome.
Yeah, I think for Gauntlet, the way to think about a bank, right, is they get deposits, they make loans. And so a lot of our job is kind of the second part of essentially, you have an investable universe out there, you have a bunch of people who want loans, and then deciding where and how to allocate that capital and size that capital. That's really how I view the role of a curator. That's the best analogy for what that is.
So before that, I want to actually add on to that because, like, technically you also assess risk, don't you, right? As a curator, right? So I need a little bit of like reconciliation on the fact that you, as an oracle, right? Like, you acquired Credora, right, and you do risk analysis as well through Credora, right, and you do risk, is this like, you know, how does that reconcile when, you know, you are trying to like curate and stuff like that? How do you use something like Credora? And then of course, like, you know, we could tie it all back to Morpho in a bit.
Yeah, sure. I mean, I can start. So I think the way that so you're right. You do, anytime you're making a loan, you're assessing risk, right? So you're assessing, is the reward I'm going to get commensurate with the amount of risk that I'm taking? And the way to reconcile that is just that, you know, we're essentially going out and figuring out what is the best risk-adjusted reward. And then if you think of a bank, the bank essentially has a portfolio of loans that they've made over time. And I view, you know, if I can kind of speak for Marcin, I view kind of their role as assessing the individual banks, right? So different banks have different loan profiles, different risk profiles, different things that they're trying to go for. And so then I think that's where the risk ratings there come from. There also are cases where RedStone or Credora will do risk ratings on also, I guess, the loans that we would make. But I don't think that they're kind of competitive in that sense. It's just having, for example, like rating agencies do rate banks and the portfolio of loans, and they also will rate individual loans. So I don't think those are, you know, it's very analogous.
Awesome.
In a nutshell, I would say Gauntlet is taking like 10-page view, like a very in-depth analysis before they take like any action. And for Credora, it's more like giving some simple, digestible ladder to the end user to understand roughly, is it an A, is it a B, is it a C? And then if that person is interested, can read more. But for like the general public, you need to abstract away complexity as much as possible and give something that is just super simple to decide on.
Awesome. Merlin, what are you unbundling, and how does it all work into play with those two folks there?
Right. Morpho is the infrastructures to build any bank, funds, or any like financial services that involve credit on top of the Morpho network. So it's really like we're focusing on that infrastructure that lowers the cost of operations to zero. So I would say it's like basically unbundling the lending desk and making sure that all operations are automated, the accounting is automated, you don't have to worry about quarterly reporting because everything is on chain available. And you have that nice and flexible infrastructure that allows you to really create the product that you want, have end-to-end ownership because it's like fully immutable, and also have the flexibility to create and configure the product as you want and decide which exposure and for you want for your users.
Amazing. So now, let's move on to maybe a topic that everybody wants to talk about, because you said 20% yields. No. No. So the thing is, you know, working at Coinbase recently, I've just been talking to a lot of institutions, and you know, the staking ETFs like started to go live in the U.S. And I've been in these calls with these ETF issuers, and they always ask about yield, like, you know, for staking. And it's just trying to get as much like juice from the squeeze as possible, right? Yeah, they literally asked me like, okay, how can we make this larger? How we can make this better? You know, every BIP matters. So I called it the BIP war, right? So in what I've been like thinking about is the fact that it, like, you know, yields are being compressed, and like, you know, staking is commoditized. They're probably going to start looking more, institutions specifically, and everyone else honestly, to on-chain yields, right? Like, you know, DeFi yields, stuff like that. So the one thing I want to talk about first, actually, for you, Marcin, and RedStone, right? Because you run an Oracle, right? Oracle extractable value, right? When an Oracle like updates a price, like value leaks arbitrage to like bots, and there's like a way to capture that, right? So level with me here. Is that a way to like actually increase like on-chain yields, or like, you know, how does that work specifically? Because like we've had this whole thing with like MEV in general. So like walk us through that.
Yeah, so that maybe let's start how a liquidation works. So you always have a liquidation threshold. Imagine the value of your collateral starts to drop, and at a certain point it hits the liquidation threshold, meaning your position can be liquidated. How it used to work, mainly on Ethereum mainnet and other chains, is that the Oracle update hits on chain, and at that moment everyone sees that a specific position is underwater. So people, and whenever you're liquidating a position, you're getting a liquidation bonus, so that people, the liquidators, are actually incentivized to close that position. The problem is when the liquidation bonus starts to be negative, like when the bonus is lower than the actual value of liquidating that position. So you want to do it quickly, right? Like, because if the collateral keeps plummeting, it's just like a window of opportunities in a sense. So whenever it hits on chain, people fight to get the priority pass to liquidate that position. So they would pay a priority fee to block builders and the MEV searchers to get their liquidation transaction being prioritized and then being the one to close the position. So the whole actual margin from closing the position goes to the block builders because they're kind of like bribed to include your transaction. With Oracle extractable value, you try to change that value chain flow, creating a flash auction before the transaction lands on chain. So listen out. The price originates off-chain usually on centralized exchanges, decentralized exchanges, and we keep updating that off-chain.